Hi everyone, I had to look at this market today from scratch. Knowing what I know about the Fed, SoFi's earnings, the AI money stampede, and the way investors are acting when guidance is even slightly cautious, I would not start with the red candle. I would start with one question. Did the business break? Or did the market simply refuse to pay for the business today? Because those are not the same thing. And in this market, confusing those two things can get very expensive. SoFi just reported a quarter that, on paper, had a lot of strength. Record revenue, record loan originations, member growth still running hot, products still expanding, profitability still moving in the right direction, and yet the stock got hit like the company walked into earnings and said everything is falling apart. That is not what happened. Today is Thursday, April 30th, New York time. Comment the day and date you're watching from, because depending on when you see this, the market may already be deciding whether this was panic or whether this was the start of a deeper repricing. And if you value my content and want to support the work, subscribe and comment John A.G. Best. It tells me you're here for the real breakdown, not just the noise. So let's get into it. The first thing you need to understand is this. The stock did not fall because the current numbers were ugly. The stock fell because Wall Street wanted more certainty about the future. That is the whole thing. Investors looked at the quarter and said, fine, the business grew. Fine, members increased. Fine, earnings improved. But why didn't management raise guidance? And that question hit the stock harder than the actual earnings report helped it. Now, based on the latest public filing, SoFi's adjusted revenue was up a bit over 40%. Total loan originations reached roughly $12 billion, members moved close to 15 million, and products crossed a little above 22 million. That is not a sleepy bank. That is a fast-growing financial platform with real scale. But the market is not grading it like a fast-growing platform right now. It is grading it like a rate-sensitive financial stock trapped inside a bad macro room. And that is where the Fed comes in. The Fed kept rates unchanged. No surprise there. The surprise was the tension inside the message. The official statement said economic activity was still expanding at a solid pace. Job gains were low on average, unemployment had not moved much, and inflation remained elevated partly because of global energy prices. That is not the kind of language that makes rate cut bulls feel comfortable. It means the Fed sees enough strength to avoid rushing, and enough inflation risk to avoid celebrating. So if you own a company like SoFi, that matters. Lower rates would help refinancing. Lower rates would help home loans. Lower rates would help student loan refinancing. Lower rates would help personal loan demand. Lower rates would probably improve the way investors value the stock. But if rates stay higher for longer, then the market keeps saying, prove it. Prove the growth is durable. Prove credit is fine. Prove customers are still borrowing. Prove the bank model works without a macro tailwind. And that is why this earnings reaction got so emotional. Because the business said, we are still growing. The stock said, I do not care yet. Now, I want to be fair here. This was not a perfect quarter. Anyone telling you it was flawless is not doing you a favor. There were weaker pieces. The technology platform had a real decline. A major customer left the platform before the year started, and that showed up in the numbers. Accounts on that side were down, revenue on that side was down, contribution profit was down. So if your entire SoFi thesis was, this is going to become the giant infrastructure layer for Fintech, then yes, this quarter gave you something to think about. That old dream took a hit. But here is the important distinction. A damaged tech platform story is not the same thing as a damaged company. The core financial services business is still adding users. Lending is still producing. Deposits still matter. Cross-sell still matters. Brand awareness still matters. The bank charter still matters. And the company is still building products across banking, investing, lending, crypto, and future payment rails. So you have to ask yourself a very uncomfortable question. What thesis do you actually own? If you bought SoFi only because you thought the technology platform would become the main event, then maybe your thesis changed. You should be honest about that. But if your thesis is that SoFi is becoming a modern, digital-first financial institution with growing members, improving profitability, and a long runway to cross-sell products to a younger customer base, then the thesis did not break. It got tested. And there is a huge difference. Most investors do not sell because a thesis breaks. They sell because the price hurts. Then after they sell, they invent a thesis break to feel better. That is human, but it is dangerous. Because when a stock is up, everybody talks like a genius. When the same stock is down, suddenly the CEO is terrible. The business is a scam. The numbers do not matter, and the whole thing was obvious all along. Come on. If this stock had gone up after earnings, the same people would probably be saying, strong quarter, conservative guidance, great long-term setup. That is why you cannot outsource your thinking to the chart. Now let's talk about guidance, because this is the real pressure point. Management kept the full-year view steady even though the rate assumptions got worse. Earlier expectations had some cuts built in. Now the company is basically planning as if those cuts do not show up. That is a more conservative setup. But it also means Wall Street did not get the raise it wanted. And in this market, not raising guidance after a good quarter can feel like a miss. It may not be a real miss, but it feels like one, especially when investors are already nervous about rates, oil, credit, and consumer health. From recent market updates, oil and Middle East uncertainty are still a problem because energy prices can feed inflation. And when inflation looks sticky, the Fed has less room to ease. That is why a geopolitical headline can hit a fintech stock. It sounds disconnected, but it is not. Oil affects inflation. Inflation affects the Fed. The Fed affects rates. Rates affect lending. Lending affects SoFi. That is the chain. And right now, the chain is tight around the stock. Now, could the market be overreacting? Absolutely. But could the market also be making a rational point? Yes. That is the part bulls need to hear. Maybe investors are saying we respect the growth, but we do not want to pay a premium until we see cleaner guidance, better technology platform momentum, and a friendlier Fed. That is not crazy. That is a real argument. A fast-growing bank is still a bank. Credit matters. Funding costs matter. Loan demand matters. Macroeconomics matter. This is not a software company where revenue can be valued in a vacuum. This is finance. The cycle always has a vote. At the same time, the bearish side can go too far. Calling a profitable, fast-growing financial company broken just because the stock is down double digits is lazy. The numbers do not support the idea that the business collapsed. They support the idea that expectations were too high. The market wanted a cleaner guide, and fintech is out of favor while AI is soaking up attention. And that AI point is massive. Look around the market. Big tech earnings are becoming a referendum on one thing. How much money are the largest companies still spending on AI, cloud, chips, power, and data centers? Investors want to know whether the AI machine is still hungry. And as long as that machine is hungry, capital keeps running there first. That creates a problem for companies like SoFi. Because even if SoFi grows, it has to compete for investor attention against companies building the next layer of artificial intelligence infrastructure. That is not fair. But it is real. And markets do not care about fair. So if a company is not clearly tied to AI right now, it often needs to be nearly perfect to get rewarded. SoFi was not perfect. Robinhood was not perfect. A lot of fintech was not perfect. So money moved elsewhere. Now, the crypto and stablecoin side is interesting, but do not overhype it yet. SoFi has brought crypto products back, and it is working on stablecoin-related products and faster payment ideas. That could matter later, especially as regulated financial companies try to connect traditional banking with digital assets. But today, it is still early. It is optionality, not the main engine. Same with business banking infrastructure. Interesting? Yes. Potentially important? Yes. Proven enough to carry the stock today? No. The main engine today is still the financial services machine. Members, deposits, lending, products, margins, credit, and guidance. That is what matters. But there is another thing people miss. Volume itself tells a story. When a stock trades far above its normal activity after earnings, that is not just one group quietly changing its mind. That is funds repositioning, short-term traders reacting, options hedges moving, retail investors panicking, and algorithms reading the same guidance language at the same time. So when you see a violent move, do not automatically assume it is one clean message from the market. Sometimes it is 10 different groups all pressing buttons for different reasons. And SoFi sits right at the intersection of all of them. It is a growth stock to growth investors. It is a bank to bank investors. It is a fintech to fintech investors. It is a macro trade to rate traders. And it is a battleground ticker to retail. That makes the stock messy. It also means the company has to communicate better than most. When a business has this many moving pieces, management cannot just say, "Trust us, it all comes together later." The street wants a bridge. It wants to know how lending growth turns into earnings, how deposits lower funding costs, how crypto becomes revenue, how the technology platform recovers, how the modern core and business banking products become real, not just interesting. That is the next burden. Execution is no longer enough. Explanation matters too. And that is also why the comparison to traditional banks is tricky. A giant bank may grow slowly, but investors understand the model. They know deposits, loans, credit, capital, dividends, buybacks. With SoFi, investors are still deciding what box it belongs in. If the market calls it a bank, the multiple gets smaller. If the market calls it a platform, the technology segment has to act like a platform. If the market calls it a fintech, sentiment swings with every risk-on and risk-off move. SoFi is trying to be all three. That can create upside. It can also create confusion. And confusion usually gets discounted. That is why I keep coming back to the same point. The company does not need a cute story, it needs clean proof. Another quarter of member growth is good, another quarter of strong originations is good, but the re-rating probably needs more than that. It needs visible operating leverage, better platform confidence, and a rate backdrop that stops punching the stock in the face. Could that happen? Yes. Is it guaranteed? Absolutely not. That is why position sizing matters more than emotion, especially when every headline feels bigger than it really is for long-term investors in real time. So what should you actually watch from here? First, watch credit quality. If charge-offs stay manageable, the bear case loses power. If credit starts weakening, the market will get much more aggressive. Second, watch whether management can raise guidance later. A conservative guide is fine if it sets up beats. But if the company keeps beating and still refuses to raise, investors will keep asking what management sees that they do not. Third, watch the technology platform. If that segment stabilizes and starts accelerating again, the broken narrative discount can shrink. If it keeps disappointing, SoFi will be valued more like a high-growth bank and less like a platform company. Fourth, watch the Fed. Not just one meeting. Watch the direction of expectations. If cuts come back into the conversation, the stock can re-rate quickly, not slowly, quickly. And fifth, watch market rotation. If AI keeps winning every capital flow battle, Fintech can stay cheap longer than people expect. That does not mean you do nothing. It means you stay honest. If you're successful, share your success story in the comments so others can stay motivated, because this is where investing gets uncomfortable. The easy buy was when everyone agreed. The hard buy is when the business is improving, but the chart looks ugly and the macro is fighting you, and the hard sell is just as real. If your thesis changed, do not pretend it did not. If you owned it for the tech platform dream, you need to reassess. If you owned it for the digital bank growth story, then ask whether the bank story is still moving forward. Different investors can look at the same quarter and make different decisions. That is okay. What is not okay is letting anger make the decision for you. So here is my view. SoFi did not report a disaster. It reported a strong but imperfect quarter in a market that wanted perfection. The core business still looks alive. The tech platform story is wounded. The rate backdrop is not helping. The Fed is not saving anyone yet. Oil and inflation risk are still in the room, and AI is stealing oxygen from almost everything else. That is the full picture, not bullish fantasy, not bearish panic, just the picture. The next big move probably depends less on one angry trading day and more on whether SoFi can keep executing while the macro refuses to cooperate. If it can, this sell-off may eventually look like one more painful test. If it cannot, the market will keep compressing the multiple until the story gets simpler. So watch the next guide. Watch credit. Watch the platform. Watch the Fed. Watch oil. And watch whether investors finally rotate back into fintech when the AI trade gets crowded. Until then, do not confuse volatility with truth. Sometimes the stock is telling you something important. Sometimes it is just yelling. Your job is to know the difference. And remember, this is my educational market breakdown only. It is not financial advice, not a buy or sell recommendation, and not a substitute for your own research or a licensed professional who understands your personal risk, time horizon, and financial situation.